Steve, soybean, corn, and wheat futures are near key moving average resistance. They are following the commodity index. Could grain prices trade higher?
First of all, we've seen a rally in the commodity index, corn, beans, wheat, crude oil, back up to some key moving average resistance levels. So the question is, are we going to trade over those levels? I think first, most part, when we look at the fundamentals of increased carryouts for corn, good world wheat crop numbers, and the uncertainty if China is going to buy U.S. soybeans or not, this is probably a level of resistance that we may not trade much above. It's interesting to note that the funds have turned long soybeans, and we saw a big open interest increase on Friday. So a trade in beans over the 862 area could, in fact, bring in more fund buying.
How is the market expected to react to tomorrow's USDA report? Should farmers sell a rally?
This is probably one of the key reports for the spring because the USDA will come out with the first estimates for 2021, both U.S. and world corn, soybeans, wheat, cotton, rice, and all those different other commodities. Expectations is that the report will be bearish corn, that they'll lower the demand for ethanol, raise the carryout for this year and next year. And we'll see what kind of crop size they put on it, but 178 yield would add to the carryout. And some people think that the crop got planted soon enough and quick enough that we can actually see a yield above that, which would add to the carryout. So when we talk about the East corn, about the 337 area, we could actually see tomorrow trade down to maybe 325. For the beans, the key is what they put in as far as China demand. To date, China's bought more beans and imported more beans than the USDA had thought. So their 89 million ton number might be a little low. And so if the Chinese do buy U.S. beans under the Phase 1 trade deal, it might be more new crop than old crop. And that could lower the 2021 U.S. soybean carryout depending upon the size of the crop. You could actually see tomorrow November beans trade from the 862 area, maybe as high as 880. So in a normal year, which this isn't, you could actually see a 30-cent move tomorrow, beans gaining on corn. For the wheat, the market is trading around the 520 area, and I think wheat market is a little bit overpriced given what we're seeing in the Black Sea as far as improved conditions. Certainly it's dry in the southern plains, and certainly the hardwood winter wheat crop will be lower than last year. And this past weekend, the freezing temperatures across the Midwest should not have hurt the soft red winter wheat crop, and are looking for a bigger soft wheat crop. Tomorrow, the USDA will come out with their first estimates of winter wheat production, which is expected to be behind or lower than last year, and soft wheat bigger than last year, and hard wheat smaller than last year. So we could continue to see Kansas City futures gain on Chicago. Right now, the funds have just a really small long position in Chicago wheat, and they could take that out, given the fact that wheat prices are probably a little bit too high. Again, the main feature of the marketplace is any headline news about the virus, anything about the economy and the impact it could have on food, fuel, and feed demand.
Alan, why was there only limited safe haven buying in the 30-year Treasury bond futures when stock index futures were lower in the overnight trade?
Well, the reason for this is that there is likely to be a lot of Treasury supply coming this week. In fact, the Treasury has announced that there will be $96 billion in new offerings in 3 and 10-year notes and also in the 30-year bonds. Plus, next week, the Treasury will be offering their 20-year bonds. So supply very much an issue, limiting the upside across the board. But I believe that there will likely be more pressure on the long end of the curve than the short end. So that would basically imply being long the 5 or 10-year note futures would probably be better than the being long the 30-year bond. So in other words, the yield curve is steepening, and that will affect the futures prices.
Why have stock index futures and gold both trended higher since the third week in March when they usually both move in opposite directions?
Well, of course, it is true that stock index futures and the gold market usually move in opposite directions. That not being the case, though, since the third week in March, this is basically because central banks around the world have been very accommodative. Lower interest rates are supportive both to the indices and also to the gold market. So I think this trend is likely to continue. where both gold and the stock index futures are supported by easier credit, and they now, I believe, both can move higher for that very reason.
Why are NASDAQ futures higher on the year and gaining on the S&P 500 and Dow futures?
Well, basically, it's the bull spread that is working. Being long the NASDAQ, short the other indices is considered to be the bull spread. Long NASDAQ, short S&P, long NASDAQ, short Dow, long NASDAQ, short Russell. All of those are considered to be the bull spreads. So that is a sign of potentially higher prices for stock index futures for the more volatile NASDAQ to outperform the other indices. And I think this is a trend that will probably continue. However, both sectors will probably advance. The broader index futures and the NASDAQ, I think, will be underpinned by easier credit. So the entire complex seems to be well supported.
The views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.